Okay. So following the great financial crisis, the Dodd-Frank Wall Street Reforming Consumer Protection Act was introduced to overhaul the financial services, overhaul financial regulation. And according to a Senate brief at the time the law was enacted, it said the aim of the act was to create a sound foundation to grow jobs, protect consumers, rein in Wall Street and big bonuses, and bailouts and too big to fail and prevent another financial crisis. Dodd-Frank was then followed by the Economic Growth, Regulatory Relief, and Consumer Protection Act, which was rolled back some of the key aspects of Dodd-Frank. One of the changes in it was to raise the threshold from 50 billion to 250 billion, under which banks were deemed too big to fail. And it's interesting to note that this was also supported by Barney Frank, that the 2018 Act, because the Dodd-Frank got some things wrong. Well, clearly, clearly they did get a couple things wrong, as recent developments in the banking system have really changed the economic outlook, damaging consumer confidence, and ironically, maybe doing what the Fed has been working to do for over a year, bringing down inflation, as it's going to slow credit, reduce consumer spending, and then eventually slow the economy, which we believe will bring inflation in. The range of outcomes, though, is as wide as it's been at probably any point in time in the last year or so. So let's get into it. The IMF came out yesterday with a warning about the vulnerabilities in the global economy. You can read here for yourself. I think we're dealing with three big issues at once, as Ms. Georgivina points out. You have a geopolitical and economic divisiveness that's going on. You have the world dealing with much higher levels of debt, now experiencing one of the more rapid rises in interest rates in a very abbreviated period. But importantly, it was following an extended period of low interest rates, which inevitably leads to financial excesses. And it's that mindset, though, I want to talk a little bit about today, because there's some actual economic issues with this, and there's some behavioral issues that are really important to keep in mind that played in. And then the third big challenge that's going on is this reindustrialization of the global economy stemming from the pandemic, trade wars, and the like. So I want to start by taking a look back at inflation back to the 60s, so we get a perspective on it. It has been steadily coming down, obviously, since the 80s. Each decade it's come down, but you get a sense of just how historically low inflation has been since the great financial crisis forward. This is an unusually low level of inflation throughout our history. And when you match that up to the effective Fed funds rate, you get a sense of the Fed funds following. But again, this highly unusual period that's out of bounds from the 2010 period forward. So I want to zoom in on this a little bit more and really look at this, because I think what's happened is you have changed that the policy impact that we've implemented created a very bad behavioral element where people became overly reliant on zero interest rates and the risk that you can take with them relative to the risk you are actually taking if things changed abruptly. Now, when I go back to the previous chart, you're going to see that you didn't really have, other than a couple of periods, this you've had a lot of volatility. So in fact, inflation is, in a sense, always transitory. But what you're also seeing here is a shift up where these periods are exceptionally abnormal and out of bounds. And that led to some unusual behaviors and some complacency that I think we're really dealing with now. And that's not just from market participants, but I think this is part of the problem that we had in the banking system as well. So what happened when the Fed has never tightened during periods like this. So let me just jump into one thing. The behavioral issue that I wanted to highlight came because of two things. And when I talk about it, this chart shows you on the bottom axis, you see months that it took into the tightening cycle. And on the vertical axis, you see the basis point change in the Fed funds rate. And what this chart shows you, it looks at the 5 tightening cycles since 1987. And what you can see is how abbreviated the current tightening cycle was. And just for comparison purposes, compared to the 90s period, mid 90s or 99 to 2000, those were about 13 months, 14 months. So it was about the same period, maybe a couple months less, but certainly much sharper in the increase. But when you look at, 15 to 18 or 04 to 06, where the tightening cycles were 2 or 3 times longer, and yet the amount of basis point increase was less, this is really showing you how dramatically different the period we've been in has we've been experiencing. And this is what has caught so many people off guard. And this is what I think led to some of the bad behavior. So I'm going to jump back to a previous chart, because what happened with Silicon Valley Bank, as we understand it, is they started stretching their maturities out at this point. This coincided with the 2018 Act that let them take on a little bit higher levels of risk at the smaller banks. But they really weren't prepared for this sharp an increase in rates. And this would blow up any value at risk model when you think about the speed and the size and the magnitude of that rate increase. And then you look at this compared to historic models, and you would say that the size and magnitude, again, was something that was going to throw people off. Ironically, the Fed was crystal clear when they told people what they were going to be doing, that they were going to be going through an aggressive tightening cycle. They didn't waver on that. And Powell's been overly clear on his communications on this, but people didn't believe it. They wanted to believe what's happened in the past. And I think that expectation, that behavioral element that played into this is really an important element. So how unusual is this, and why is this not like your grandparents' economy? Well, just take these 4 factors into account. Fed has never tightened during a financial crisis. It's never tightened with the yield curve this deeply inverted, with M2 contracting as significantly has, or while they're doing QT. And that just gives you a sense of how inverted the yield curve is, looking at the 10-year minus the Fed funds rate, and you can see how negative it's been for some period of time, a highly unusual time to be tightening. Or you can also look at what is coming. This is as of February, I believe, or maybe it's the beginning of the year. You're already starting to see the bank's willingness to lend. This is on consumer installment loans coming in. And this is before the financial crisis that we're experiencing now is hit. So I think this is an important element of what's going on that we have to keep in mind. The other thing that makes this very unusual and very different from what we've experienced in the past is the size of the Fed balance sheet. And if you go back to the financial crisis or even earlier, where it was sub-trillion dollars, and at the time of the financial crisis, I think it was 875 billion, and now we're pushing up towards, we hit just around 9 trillion, dropped to about 9.5, and then you can now see a little bit of a spike up as these new programs are going into place. The Fed is still reducing the balance sheet by that amount, but some of the new programs they put in place, the bank term funding program has actually has this effect of quantitative easing. Again, at the same time, we're taking $95 billion out of the system every month. So there is a lot of conflicting messages going on that you have to keep an eye on. I will just say there's 2 things that happened over the last 2 weeks that didn't get as much press that are really worth noting. And one is this bank term funding program, which may have created enough of confidence in the uninsured depositors that they will slow down the bank runs. We'll have to see. And 2, I think it did solve for part of the markdown asset of mark-to-market asset that they had when they can deposit those securities with the Fed. So I think that's helped. The other is, and this got a lot less press, and it's something Andreas and I were talking about last week, which is the currency swaps that were put in place helped calm the global system when we were having the problems with Credit Suisse and then Deutsche Bank, because it prevented a dollar squeeze that has happened in the past when you've had these kind of financial crises and people flowed funds to chase safe havens, and the dollar being one of them. That tends to create conditions where you have a currency squeeze and that what they did with the currency swaps to get ahead of that actually eased those concerns. And I think those two things, while somewhat under the radar, have done a lot to ease the financial conditions while we still haven't averted the crisis. And when I touch on that, there was a report published on Bloomberg last week by professors from Stanford, Columbia, and MIT that are suggesting that we could have a lot of hardship coming in the banking sector still. And as many as 1,600 banks may have had similar conditions with their balance sheet and assets and liabilities to what Silicon Valley had. So it's not uncommon a couple of years after a crisis to see more and more banks go by the wayside. We saw that in 2008. We saw that in the savings and loan crisis, but that projection is quite high, which means a lot of consolidation potentially coming our way. Interesting with all that, inflation expectations continue to drop, and that's going to be one of the confusing factors out there. This is the University of Michigan study. It'll be interesting to see how this study plays out over the next couple reports. But I think the expectations are that slowing economy is going to bring down inflationary pressures. We still are seeing persistent challenges and wage issues, but this is something that is really quite different with what's going on. I think part of the reason that is really confounding people is quantitative tightening. And it's so historic, as I showed you, the Fed balance sheet rising the way it did. When you look at this is a chart from the San Francisco Fed where they've taken into account not only Fed funds hikes, but also the impact of quantitative easing and quantitative tightening. And what the blue line is Fed funds, and the green line is the proxy rate for Fed funds, and going back to 76. And what you can see here is most of the time they're very closely aligned, but then you started to see a break back in these periods where quantitative easing and quantitative tightening were going on. So I'll show you the next chart, which is a closer version of this, just back since 2010. You can see quantitative easing, the effective rate is much lower than the Fed funds rate. Then you start to see a little bit of tightening coming, and then the big tightening move last year. So one of the things that I think is a challenge, and Mark Peter-Borsch was pretty clear that he thinks the Fed's got it wrong and is going to have to be more aggressive on raising rates. I think what may be a complicating factor for the Fed and why they're not being more aggressive to Peter's liking, where he was thinking we're going to get to 6%, is because if you take the Fed's proxy rate, we are already at 6%. And people are suggesting that the stresses in the banking system of the last couple of weeks would add another 50 basis points or more of tightening. That puts us in a pretty interesting spot. So I think there are a lot of complicating factors here that are why the range of outcomes is so great. So we'll talk about what we think might happen next year, but keep in mind this quantitative tightening is an unusual experiment. And again, why this is such a different period than we've seen in the past. And when you put it in perspective and look at a chart like this, and this is 13 years if you go back to the financial crisis. Think about if you're an investor, think about all the people with investment experience who started in the business in 2008. Your experience would have been, out of those 15 years, roughly 9 of those years, the normal interest rate structure was 0. Think about that. The normal interest rate structure for 2/3 of people's careers who started in 2008 was a 0 interest rate structure, versus what the reality of the historical interest rate structures have been much higher. So what behaviors you get used to, what expectations you have of central bank policy and of fiscal policy to bail out the system during times of crisis is very different than what most of us who have a longer time horizon in the business would expect. So I think this is one of the funny dynamics that's going on in creating a lot of the volatility in the markets. And just to put the volatility in perspective, I think the either the 10-year or the 2-year, I think it's probably the 2-year, has had 9 20 basis point daily moves this year already. They had 5 all of last year and 0 the year before. So we are in a very highly unusual period. I think quantitative tightening is not well understood. when it comes to reducing the balance sheet, I think that's going to throw people off. Conditions are much tighter than people think if you follow the Fed's proxy, San Francisco Fed proxy. So what's likely to happen next? This is a fascinating time. So BlackRock came out today and said the markets are wrong on rate cuts, that they're expecting 75 basis points of cuts later this year. BlackRock thinks it's going to be much more nuanced with less tightening, but no cuts. I'm kind of in that camp right now. If there's no banking crisis, no further degradation in the crisis, then I think what's going to happen is the Fed will keep tightening. The crisis don't stop until the Fed pauses or reverses historically, but I think they believe that the actions they've taken might have reined in a lot of the stress there. More to come on that. Jeff Gundlach sees it very differently. He sees the Fed cutting rates and needing to do so immediately in the next 2 months, because he thinks conditions are going to worsen that dramatically. When you have two thought leaders on both sides of the argument with such divergent views, it just speaks to how very different this environment is. I think it's going to depend on three things. I think it depends on the future data for inflation, particularly wages, which have been very persistent, but layoffs, which seem to be persistent as well. I think it depends on the financial stability, as I talked about. If they don't need to, if the crisis is contained and they don't need to pause or reverse themselves, if the crisis continues, then they will absolutely make that switch, I believe, in the near term. I think there are global considerations as well for the Fed, particularly when the ECB has been, and the UK inflation numbers were pretty concerning this last run. I think there is a concern that if the US gets too out of line with the other policies, it'll create more disruptions. But we think the economy has to slow further because lending standards will tighten. The consumer is not going to be the driver. The corporate earnings are going to be pulled in, but there is opportunities to invest in the real economy. And I won't touch on this, but it is a painful reminder that liquidity doesn't matter until it does. So here's where we're putting our money today. And I'm going to leave you with one last thought. These are real economy things. I think innovation is going to be one of the keys to drive us forward. I think there'll be a lot of M&A activity, but I think we're getting closer to the part of the cycle where rates are peaking and we'll be able to start to move back much more aggressively into the equity markets to take advantage of it. And I'm reminded of a quote from Warren Buffett that says, "Bad news is an investor's best friend. It lets you buy a slice of America's future at a marked down price." And I think we are seeing some more attractive valuations in the both private and public markets today that can be taken advantage of. So I'm going to stop there, Mark, and open up for comments or discussion.
Great. Thanks, Stephen. Any comments, questions?
Yes, Stephen, my question, these rate hikes, as you say, are unprecedented. During Volcker's reign at the Fed, were we not in a recession at that time, and did he not increase rates as quickly as the Fed has?
He was as quick at that period of time, yes. And that was in that I showed you in the chart. He did move very quickly then.
Right.
I think the conditions were considerably different in terms of we had real rates of return back then, not negative rates like we have right now. The curve wasn't quite inverted at that point. So that's one of the big differences between then and now.
Okay.
Other comments?
Thank you.
Yeah, Stephen, really interesting. I would further point out that global monetary supply has come down substantially. There's been a few upticks as of late, but that's just more fire, or more fuel for the fire on there. And, once again, as you pointed out many times, the lag in terms of the effect of monetary policy, does drag on. So the Fed has been building into it, and globally, the monetary policies have been building into a longer tail than perhaps people are thinking about. So, I am hopeful that we'll see one more rate hike and then easing and just kind of allowing the system to work itself through. And hopefully that will be the less painful way, to get us, onto the other side of this. The other thing, for the old guys club, thinking back about the S&L crisis, it seems eerily similar, but I just wanted to throw that one out there just to see if other people had recollections, of kind of similar to a degree of circumstances of where we are right now.
Yeah, I think, Bill, that was about 1,300, 1,400 banks went out over a several year period in that crisis. So it took some time. And once they had the entity that they set up for that, the receivership entity, it kind of, it was less of an issue other than for the people in those banks. It was less of a systemic issue at that point. But I think that's what they were really focused on with this lending facility that they set up, was to try and cut the runs off early and get the confidence back. And so far, we're not out of the woods yet, but it seems like they've done a pretty good job of calming things somewhat. So we'll have to see, but it is eerily similar to that.
Right.
With respect, it was less than systemic up in New York and the Northeast, but down in Texas, it was really systemic.
Yeah, well, you had a series of things there, Chris, right? It was the oil smash that was going on for years before that too. So you had a concentration risk similar to what Silicon Valley had with startups in the Southwest.
I still remember driving around Houston in the era of see-through buildings, right?
Yes, people were taking their fixtures and running, leaving the keys in the door.
All right, guys. Janan, you got a question?
I just wanted to weigh in a little bit on just confirmation. We're seeing an early stage tech and science heavy, innovation heavy companies with a lot lower valuations. Like those have definitely come down. So that opportunity to buy in early, we're seeing it. Besides what Stephen has listed, I think cloud is there. We're always going to need cloud, but we're seeing edge computing, like moving compute to the edge for processing of IoT. That's a really important thing not to be missed, because a lot of those are still early stage, still good valuations to get there. The infrastructure as a service on comms and processing, I think it's not going to be you buy this big chunk of the cloud, whether you use it or not. We're seeing a lot of infrastructure as a service. On the electrification, this electric power grid, that infrastructure is so old. When we added smartphones to electric power grid, it increased demand 30%. EVs are going to be, so much larger. And then finally, on the other infrastructure things, water treatments, not mentioned there. Water is such a huge component of health and such a global issue. We're seeing a lot in water treatment and water processing. So I just wanted to flag some of those things. Thank you.
Great. Thanks, Jen. Thank you. I threw on the screen our next event, which we're going to be talking about how the West Coast sees things. Joel, go ahead.
Yeah, I'm truly a layman in this space. I don't have the depth of understanding that all of you show each week, each time I'm on these calls. But Stephen, I just wanted to ask you kind of this question. Why? Why is the Fed doing something unprecedented like this? Is it simply because these are unprecedented times and we need to make a move like this? Or is it a question of they're doing it wrong? And if they're doing it wrong, what should we be doing differently?
That's a great question. I think it's unknowable in the present if they're doing it wrong. You only know after the fact, because their policy works as Bill just mentioned, in a 12 to 18 month lag. So they're projecting what the future is going to be and making their best decisions around that based on the information that's available. I think the Fed has to work within a mandate that is very specific to them, which is to maximize employment and achieve maximum price stability and keep the financial system stable. Those things can be at odds with each other at times. So they have to make decisions that are trade-off decisions. Part of the problem is what is in their control. They could control the quantitative tightening and they could control the rates to a certain extent, but they couldn't control the amount of fiscal stimulus that was thrown on top of the situation after they already got into a spot. So I think once you're in a certain part of a cycle, the Fed has to follow through with what they're doing. The fiscal stimulus that came in last year was over $2 trillion in the US alone, on top of $12 trillion of fiscal and monetary stimulus the previous 18 months. That's almost as much as the total economy. Or it's 50% of the economy that they were putting to work. That's way too much. So the Fed in and of itself is doing what they view as in their mandate, but they can't solve all the problems that are out there and they're being looked to. I think what's unprecedented in how they're operating in it is their view is that the banking crisis is going to be solved in part by the program they put in place for the bank lending, and therefore they have to fight inflation still because they're worried about the wage increases that are going on around there and not getting that under control. That is their mandate, so they're focused on that. And the labor market is so tight that they really can't do anything with that, so they have to really focus on the part of their mandate they can control.